Okay, so this is day 17. In today's video, we're going over momentum indicators. And these are the leading indicators that actually try to predict when the market is about to make a move. In the last video, we talked about trend following indicators. Those are reliable lagging confirmations, but today, these are the leading indicators that measure the speed and the strength of the price movement before they fully develop. Momentum indicators measure the rate of change and the internal strength of price movement. And they can see where buying and selling pressure is starting to build up before it actually shows up as that big price move. With the momentum indicators, they're trying to detect these early shifts in the market sentiment before they become obvious on the price chart. And that's why a lot of times you'll see momentum indicators gives a signal before the price actually has that move. For the three indicators that we're going to talk about. The first one I want to talk about is the RSI indicator, or the relative strength index. And everybody's heard about that. The RSI indicator is honestly one of the most popular leading momentum indicators that people talk about. Remember, we were talking about that internal strength. So it gauges that. The RSI indicator measures the internal strength on a scale of 0 to 100. And so it's trying to predict exhaustion points before the price actually reverses. So a lot of times people will say, okay, well, if you see it above 70, then that means that buying is overdone. So you have a potential reversal that's coming. Then if you see that it's below 30, then that's predicting that selling is overdone or oversold, and that a bounce may be in the near future. And the actual leading signal with these momentum indicators is what's going to be called divergence. Okay, and I feel like we've talked about that a few times before, but I really want to get more into it. Divergence is when the price makes a new high or low, but the RSI doesn't. It does the opposite. And so that's the RSI predicting weakness in that momentum before the price shows up. Here's something to think about. Because the RSI indicator is a leading indicator, it can stay in an overbought or oversold position longer than you would expect it to. Okay, so in those scenarios, it's predicting that a reversal is likely to happen, not that it's happening right now. So that's one of the downsides of just using leading indicators by themselves. The second indicator I want to talk about is the stochastic oscillator. This is even more sensitive than the RSI is because it's trying to catch momentum shifts even earlier. With this indicator, it has two lines, the %K and %D. And this is pure leading indicator logic. When both lines cross above 20, then that's predicting that upward momentum is building up. And when you see both of those lines cross below 80, then that's predicting downward momentum is starting. Like, I love using stochastic crossovers for early entry